which is down 0.4%. So 55,930. And the mid-cap index is down 1, small-cap index is down 1. So unless things worsen significantly from here, 0.5% cut, not bad at all, given a lot of the hullabaloo that we have been seeing. Of course, the news hit as a bit of a shocker, and I explained why the disappointment, particularly vis-a-vis other countries. You heard Pearl Global as well talking about one of the most much anticipated sectors, which was to benefit, which is textile, which has not happened. But this is not bad. 0.6% lower. There's one name in the green, Geofinancial. 49 stocks in the red. That's the heat map. Surabhi.
This could have been any morning, Prashant. Just about 0.6, 0.7% down. This could have been any morning. So, you'd say it's a fairly resilient start by the market. And let's see, and we'll ask Nilesh in just a bit, domestic institutions, whether they'll use this opportunity, whether there'll be big buyers today or not. What's his sense? We'll get to Nilesh in just a second. But stocks right now, Tata Motors is still negative, reacting to their decision to, buy that stake in the Italian CV maker. 2.5% lower on that stock. BEL is on the lower side. Reliance is a drag this morning, 1.5% down, not offering too much support. Mahindra, pretty decent performance, but it's that kind of a day, taking some profits off the table. 1% down on M&M as well. So overall, stocks are down between 1 to 1.5%. Tata Motors is the one that's down nearly 2%. On the upside, Geofinancial up about 0.7%. There's some buying on an SBI Life. The stocks that are closest to the flat line are coming in from the FMCG space. So let's see if they break into positive. Nestle, Lever, ITC, Asian Paints, there the cuts are the least. And Infosys, remember yesterday Mr. Salil Parekh sounded not as bearish as TCS. There was no talk of job cuts at Infosys. In fact, he was saying that Infosys is hiring 20,000 freshers this year. Stock is down 0.5%. I'll watch for FMCG and IT very, very carefully to see if some buying emerges with these stocks. But right now, still down 200, Nigel.
Well, Welspun Living, that's taking it on the chin, down 6% as we speak. So that would have been a potential beneficiary if in case the tariffs are lower. Now the street doesn't like what they've seen, 6% lower. Trident is down another 3.5%. So big hit on that one. New India Assurance is giving up some part of the gains that it put on yesterday. And Indus Stars, well, those numbers were disappointing and the dividend pushback as well. So the street is punishing that name. What's doing well? Sagility, that's up close to around 5%. Those numbers look pretty good. You have Geo Financial that's doing a relative outperformance. The reason being the promoter entity is showing the faith and, putting in money. And Grief's Cotton is actually one of those stocks that are actually outperforming today on rather large volumes. A big up move is what we are seeing. And HEG as well. They've been talking about realizations improving. Now they're going ahead and, in fact, announcing a capex as well. So they're readying themselves for the next 2 to around 3 years when they expect demand to come back. The street likes it, explains why. That name is up close to around 5.5% as we see.
It's 300 up and about 2,000 lower. That's the sort of count of advanced decline out of the gates, right? Just the first initial couple of minutes of trade, but that is what it is. Sagility is another one which reported a super strong set of numbers, and that is reacting at about 4% or so. It's not done very much since listing. That is Sagility out there. Look at the volumes as well. I think Nigel mentioned HEG, Greaves, etc. 5% each there. At this point in time, and you got Eternal, DMart, Geofinance, etc., which are also slightly higher. Nilesh Bhai is with us, and we've been sort of talking tariffs and markets with him. Nilesh Bhai, you think we will see a concerted? Thanks for waiting, first of all, and as we took that detour, do you think we need to see and we will see a little bit of pump priming from the government? Do we have space for that? Nilesh Bhai, especially on GST rationalization, RBI is already really behind growth in a big way over the last, since the new governor took over. What's your sense?
So on the monetary policy side, both in terms of rates and liquidity, enough action has been taken. Now, on the rate side, there is still room because this year inflation is expected to remain lower. On the other end, on the fiscal side, we have a lot of space, but we are committed to fiscal discipline. So my recommendation will be, let's give GST cut or any other support which is required and balance it through divestment or asset monetization. There is still room for both divestment and asset monetization at current level of liquidity and market, and that should be used to support the domestic growth. But apart from those short-term measures, what we really need is encouraging local industry through improving ease of doing business. We have taken many steps to improve ease of doing business, but that animal spirit is still missing in private investment. We have to sit with private investors and listen to them about their issues. Some things could be related at state and local level. Something could be related to local purchases. Something could be related to new age industry. Essentially, we need to accelerate growth supporting policies through improving ease of doing business as a medium to long-term answer.
Nilesh, so before we let you go back to your usual business today, that's the question. I mean, mutual funds have been the biggest support for this market. You expect on days like today, there would be big buying, and how are they looking at it? Because there's always that debate that foreigners are selling, saying valuations are high and, earnings are not coming through. But domestic MFs, because they're getting the money, they're simply going out and buying. Of course, latest MF regulations could look at changing that. You don't have to buy if you have a lot of money, but more on that later. But just now for today and next couple of days, what do you expect?
And what's the liquidity position, Nilesh, if you could help us out?
So, Nigel, we have reasonable liquidity in terms of cash. Average balance will be between 3 to 5%. Second, we also have asset allocation fund and balance advantage fund, which can increase equity as and when market or valuation starts coming down. So collectively, anywhere between 200,000 crore to 300,000 crore could be potential liquidity with domestic investors. More importantly, so we are not here to support the market, we are here to make money. When there is so much of uncertainty, will we be aggressive buyers? Answer is no. We will wait for prices to settle and then build position. So clearly, we will be a buyer, but we will buy where we believe valuations are in our favor. Foreigners invested from the mid-90s, they have made money and hence they are booking profit. We were a little late in accumulating Indian growth story and domestic investors are buying now. Now our collective ownership exceeds foreign ownership. More importantly, it is also time differential. We are long-term investors. Many foreigners are probably taking a shorter-term call. So at the end of the day, if prices go up, both domestic and foreign investors will benefit.
Okay, all right. Nilesh, thanks a lot for joining in. I always take your advice very seriously. And as I always tell you, I'm keeping the faith. So as you said, time to look at it for the longer term. Appreciate you joining in and giving us your comments. That said, let's get in Anand Shah, Chief Investment Officer, PMS and AIF at ICICI Prudential, who joins in. Hi, Anand. Good morning. Not the best morning, right? Because India was hoping a few months ago that we were off the blocks in a flash and maybe we get a favorable deal. That's not come about. But if you look at the reaction, initial reaction, it's not too bad, actually. What's your view? Do you think the street was sensing that this is going to be, a bit tricky, and that's why we have already pulled back close to 4% in the last month, and we were already underperforming what global equity markets were doing?
Hi, very good morning. And yes, to that extent, this is not completely unexpected. The negotiations have been going on for quite a while, and this is what it is. The way I look at it, to me, now we know what's the worst case scenario, be it at a economy level, at individual sector levels, or at individual company levels. We know what is the worst that can happen. All said and done, these tariffs are disruptive in a massive way for all the industries and all the companies in all the countries who are in a way trading with US. And to that extent, it's no different for the Indian companies also. The good news is that India, in that sense, is not that much export-oriented. It's not been that successful in exporting lots of goods into the US market. And to that extent, the overall impact on the Indian economy and Indian markets would be much smaller than what it otherwise would have been for any of our neighbors who have significant reliance on US exports for their own GDP and growth.
Hi, Anand, great to have you on. I want to talk to you about Pharma, right? Because Pharma actually has been very resilient in all of this topsy-turvy environment. The Pharma index is up about 6-7% so far this year. Individual stocks have done more. But there is that sword looming on Pharma as well. God knows what happens next. How are you positioned on the sector?
So again, not only pharma, if you see the overall exports basket of India, again, it's not that we are making either supernormal profits in many of the sectors that we are participating, like textiles and others, or we have a significant competitive edge, which is the case with pharma. So to me, I think the expected impact of the tariff on overall exports from India would be far more muted than what we believe or what the market believes can happen because of that tariff. I think overall, if you see the tariffs as a whole, eventually it will be borne by either companies which are making supernormal profit, either in US or outside US. So either it's manufacturer or retailer. But if that's not the case, if the market's not been very efficient and companies are not making supernormal profit, eventually the consumers in US, which is going to pay the price for that. And that's no different for pharmaceuticals also. So to me, that's not today the case. They have exempted pharma for the time being. And to that extent, that's not under debate today. But I'm saying generally, it's not that India has exports where the margins are very high. And to that extent, we will have to absorb some of the tariffs. I think a lot of tariff eventually will be absorbed by the consumers in US.
All right. Anand, since the global space is in a bit of a flux, a lot of focus on the domestic themes. If you had to pick up that one domestic theme that you like, which one would it be? Give and take everything, give and take things are going to improve from here on. What would that sector be?
So I think India is significantly domestic, and within that, there is consumption of goods and there's a consumption of services. India is, as the per capita income grows, services consumption is becoming increasingly a larger pie of the overall consumption piece. So say pre-2000, we would have been 65% consumption of goods, 35% consumption of services. As we speak today, it would be like 50% consumption of goods and 50% consumption of services. So I think one piece which we have been closely watching and we've been sort of invested also is the consumer services business, be it telecom, be it healthcare, be it transportation services, be it entertainment services, be it financial services, wealth management. Those are the areas where incrementally the Indian household is spending or / investing in those areas.
But Anand, with the equity market being so ranged, isn't there a bit of a near-term threat maybe to some of these capital market businesses? They've done really well, right? Those who managed to ride the wave, they've made a lot of money. But now within capital markets, if you have to take long-term bets in the portfolio, would you be with exchanges, with wealth managers, with asset managers? What parts of it?
No, indeed, these are all plays on capital markets. And as you rightly said, they will have a higher beta to the overall economy and the markets than what otherwise the rest of the sectors would have. Having said that, I think markets have been expensive for a while now, and we've been all along talking about it. So I think from investors' point of view, I think they need to brace for, notwithstanding the tariff thing, you need to brace for corrections in the market as it is, given we had a very, very sharp fall from October to Feb, and equally sharp rally from Feb end to June end. So I think overall economy is slow. It's known. This tariff uncertainty has further put pressure globally on the global growth, on the US growth, on the China growth, and that's also impacting. I think the first step in terms of monetary easing is there. I think we need to continuously focus on improving domestic consumption, and I think the lower interest rates and higher liquidity in this banking system.
Sure.
Credit growth pick up and a little bit of a domestic growth pick it up.
Okay, so keeping the faith on the capital markets side of the market itself, businesses. We'll take that on board and, remember that one. Thank you very much, Anand, for joining in on what's been a very, very news-heavy morning for us over here. Market's all right. Market's been, holding with a cut of about 0.6%, so not too much of a wider fall. Well, let's welcome in Neelkant Mishra, Chief Economist at Axis Bank now, and also the Head of Global Research at Axis Capital. Neelkant, great to have you on this morning. So it's just feeling worse, right? Because everybody's gotten this 15% deal, including South Korea this morning, and we've been handed out 25% plus, quote-unquote penalties for doing business with Russia. Let's talk numbers first. I mean, numerically, what is your assessment in terms of GDP hit? And then what could be the second order effect? Because this seems to indicate that there is maybe a reset in the relationship equation. Maybe yes, maybe no. But your first thoughts.
Okay, so let's first quantify it. So the tariffs paid by Indian exporters when they entered the US market before April was about $2.3 billion. As the 10% tariffs came in April, and then there was a 50% for all steel coming into the US starting June, the numbers had gone up to about $8 billion. So that 2.3 had become about 8. If 25% sticks, then we will be at $18 billion. So there is a $10 billion extra impact. If you were at 15, the number would have been 12. So basically you would have been, so we're talking about an increase of about $6 billion a year on last year's export numbers. And clearly now, I think, as you said, the second order impact on what happens to electronics exports, what happens to apparel exports, there was a lot of expectation that we may have an advantage at these prices or these rates. We may have a 5% disadvantage. Some of this, if these indeed stick, see, I think the message here is that even South Korea was threatened at 25%, but they ended up at 15. So maybe this is the preliminary, the pre-final step to the final tariff. And in a way, I read it as that 15% would be pretty much the floor. 25% now seems to be the ceiling. We will see the penalty, which I think is more sophisticated geopolitics, but that would be the range in which we end up settling. And I don't think it's very substantial. I don't think this is very important from a macro perspective.
Neelkant, I'm so sorry I'm butting in because this ties in with the second part of my question, that the number and the tariff is one piece. But look at the commentary, and this is the latest quote coming in from Mr. Trump. We'll put it out. There we go. The flashes are on the screen. And look at the language. He's saying, I don't care what India does with Russia. They can take their dead economies down together. These are words from the US president. We have done very little business with India. Their tariffs are too high, among the highest in the world. Likewise, Russia and the USA do almost no business together. Let's keep it that way. I mean, these are really strong statements. Maybe this is rhetoric, maybe this is more pressure tactics, but that's what it is.
It's midnight in Washington, D.C. I mean, I think we should just ignore it. I mean, it means nothing, really, right? I mean, maybe it's just somebody's asked him something. We don't know what was asked. Maybe he's irritated, lack of sleep.
Irritated?
No, I'm not joking. I'm serious.
I
don't think. Look at all the other statements which have come from President Trump, right? I mean, everything has started with India is a friend, Prime Minister Modi is a friend, etc. Yeah. Of course, the tariffs are a different business, but I think we should just take it off. There's no real reason for us to sort of focus on this statement per se in that sense.
No, but Prashant, I mean, for the sake of a healthy debate, I mean, I just put the other point of view, and that's the question that I was actually, let's ask Neelkant this. That a lot of this, maybe it's just rhetoric, maybe it's pressure tactics, Neelkant. Tell us what you think it is. But would this make investors, stand up and take note that these were these two great countries coming together to do business, but now there seem to be fissures on us buying Russian oil, us buying Russian defense equipment, us not yet saying yes to the F-35s. Is this a bigger reset? And then if yes, do markets need to be concerned?
I don't think so. What I think the markets need to get used to is what they say in diplomatic speak, an absence of binaries. That most relationships, I think, in the next decade, 2 decades, are likely to be quite complex. The thawing of relationships between India and China for example, is also a very meaningful development that has happened. So on the one hand, I think the strategic competition with China remains intact, but at the same time, there is an access to our markets that we can provide and on our terms in return for their technology and their capital. Similarly, with the US, I mean, the headlines in today's papers, you would have seen on the one hand, there was a 25% tariffs, and right next to that was the launch of NISAR, which is ISRO and NASA launching together. And from what I understand, there are very deep-rooted connections between India and the US. This is, we have to put this thing in perspective, that there is a $6 billion impact. I don't want to underestimate or emphasize that, this is nothing at all. There is an impact. There will be an impact on apparel. There will be an impact on jewelry. There will be an impact on electronics. But again, this is something that India needs to counter through maybe fiscal support measures, through other regulatory measures. Because what India, and if you see the Indian press release, it very clearly states that, look, we have limited room for maneuver on the agri side. I think that one of the issues not stated in the press release that even if we cut duties, the impact has to be graded, meaning over a period of time, it cannot be sudden. And those are things that India is unwilling to negotiate. Now, can there be other grounds on which common ground can be found? Perhaps yes, but I would not interpret this as a complete break of relationships, because these are strategic partnerships. President Trump is still coming in October for the Quad Summit. So, at this stage, I think the market should be best off just thinking about it as a $6 billion impact, and let's see where the negotiations go next.
Okay, all right. Hi, Nilkant. Good to see you, Ben. What about flows? The other worry is we can quibble about, what's going to happen with regard to duties, whether or not it'll be lower or not. But the fear is that as it is, we were not getting a large chunk of the FI flows. And now, in fact, because of this sort of engagement that we're having in the United States, maybe that further moves away. What's your take with regard to flows?
Again, we have to think about individuals looking at their own self-interest. And so investors have to see India for where we are. If a very significant amount of monetary easing has happened, as of now, the economic momentum is quite weak. It perhaps is still weakening. But with the extent of monetary easing, the economy should revive. Now, on the flow side, we've been studying this every month. And frankly, India is not an outlier. So over the last 12 months, if you see flows as a percentage of market cap, India is somewhere between 1 and 3. And, the country that has got the second most, China. So if you think that US and China are somehow becoming friendlier, they're not. This is a contested relationship. It's a complex relationship. And therefore, I would not think that the flows beyond maybe 1 or 2 days here and there would actually be affected substantially. They will be much more affected if the monetary easing that has been pushed out pushed by the Reserve Bank and the Monetary Policy Committee does not result in meaningful credit growth in the next 6 months. For me, the fact that the real estate cycle is stalling, that for me is a much, much more important variable than, tweets. And frankly, it's not even a letter yet. It is, I think, this is like the semi-final, pre-final that, it is stalling. Let me put some pressure. Let's get people to start, finalizing quickly.
I got it. All right. So $6 billion in terms of increased tariffs, not too concerned about flows. It's not an India-specific issue. So we got that out of the way. But you spoke about monetary policy. And now the hope is there could be some easing. What kind of action are you factoring in from the RBI? Because clearly the economy, the most data points, you get power, other consumption data points as well. It's soft. As of now, it's soft. The hope is from September onwards, we see a recovery. What role does the RBI have to play in this?
Okay. I'll take a minute to answer this. If you think about a 7% potential growth rate, you have cyclical factors on the fiscal and monetary side. In the last 2 years, as the government was doing fiscal consolidation by 80 basis points each, and just 40 basis points this year, you are effectively starting. I know I'm oversimplifying, but I think it's very useful to think at a framework level. Your potential growth is 7, but if the government is shrinking the fiscal deficit by 80 basis points, you were starting at 6.2 in the last 2 years. This year, you're starting at 6.6. Then there is the monetary overlay. In March 2024, credit growth adjusted for the big merger that happened was 16.3%. It became 12% in March 25 and 9.8% in May 25. So there is a 6.5% point decline in credit growth. Now, given that banking system credit is about 56% of GDP, this is a more than 3% of GDP impact that we have seen because of monetary tightening. Some of it, I think, was intended. Some of it was absolutely unintended. I think the RBI ended up using very blunt tools last year, which has resulted in some of these problems. So the economy, as we speak, I think your read is right, is still weak. In fact, it may still be decelerating. When monetary easing happens, the channel through which it is most potent in India is credit allocation, meaning that financial firms need to get the risk appetite to start taking on more credit risk. As the economy is decelerating, it becomes harder and harder to do that. But still, given the extent of the easing, I think it's a reasonable assumption that there are some financial firms which still have the balance sheet, they don't have the NPAs, they can start pushing through. And once the first 1% point increase in credit growth starts to happen, which is, I think, maybe November, December timeframe, the economic acceleration after that should be quite substantial and very, very rapid. That's our opinion.
That sounds very, very reassuring, just the kind of reassurance perhaps one needs, Neelkant. And, I was just coming to exactly that point. So you're saying October, November onwards, the acceleration should pick up. So let's just, understand what you're baking in right now. How many more rate cuts? What kind of a pickup in GDP growth? And are you factoring in anything more from the fiscal side? We've already got that income tax cut. Is there anything else that you would expect or, at least wish that the government considers?
So on the monetary side, see, there is prescription, there is prediction. So prescription for me is that nothing more needs to be done for now. Because remember that the channel through which we are expecting monetary policy to act is not the cost channel. So we are not saying that if you make loans 50 basis points cheaper, credit demand will accelerate. Because the challenge here is risk aversion in the economy, risk aversion in the regulators, risk aversion in the financial system. Just to give you a sense of what I'm saying, back in 2013, nearly 60% of bank loans were at interest rates about 12%. And I totally get that this was a high inflation environment, that things were growing faster and all that. But that was the level of risk. Today, it is less than 11%. In the last 1 year, the incremental share of 10% plus interest rate loans has collapsed. So it is about, so when the problem is risk aversion, I think rate cuts are not going to help. So I think what you need is much more, I would say, procedural changes, and which we can discuss when we have more time. But on the fiscal side, I don't think there is much room. In fact, what I apprehend or what I'm apprehensive of is that in the next couple of months, there may be market concerns emerging that tax collections are falling short. Remember that these things are all very cyclical, they feed on themselves. But hopefully that will be temporary. I don't think the government intends to miss its fiscal target. So if it means there may be more disinvestment, there are other tools available which you can use to sort of meet the targets. And so fiscal, I don't think there is room. I don't think there is even intent to change this. I think the government is likely to wait for the reduced cost of capital, that the 10-year bond yields are low, the equity capital is cheaper, and let entrepreneurs then do their thing. So I don't expect anything to happen, but I do expect that with a lag, the monetary easing should lead to greater credit risk appetite for borrowers. And I think demand is there. I mean, most people say, oh, there is monetary easing, but where is loan demand? In an economy like India, credit demand is always ahead of credit supply. If you see some of the NBFCs lending at 28% viably, it tells you that that the demand for credit is all there. It is a question of when the financial firms and the regulators become much more comfortable allowing firms to take credit risk.
Yeah.
All right, Neelkant, thank you very much for joining us. Good speaking with you. And as you said, we'll invite you over for a longer discussion, but I think very, very useful, very insightful as always. Thanks indeed for being with us here on the program. 140 points lower. Nigel, I think we have the management of KPIT with us.
Well, that's right. Let's focus on that one then, the earnings reaction. KPIT is on our radar. Well, the last quarter's performance was a little bit subdued, but the management is optimistic on growth momentum in the second half of the year. Let's talk more about the past quarter's numbers. Mr. Sachin Tikekar, the joint MD, joins us on the show. Hi, sir. Good morning. Thanks a lot for joining in. Well, you're indicating the second half of the year will be good. But do you think quarter two as well, we are bracing for a bit of degrowth? And going that quarter, the first half is going to be soft, second half is going to be better. For the year, give us a rough range in terms of growth. What are you looking at?
Absolutely. First of all, thanks for having me. So first of all, we are happy with the performance of the last quarter. It's in line with our expectations. We were able to hold on to our margins, which is very unusual these days, at 20% EBITDA and more than 17% EBIT. The top line was as expected. What we are seeing is, first of all, the deal closures have gone up. The pipeline continues to look robust. It's just that there are certain things that are still hanging up there. And hopefully, we've been talking about tariffs and the geopolitical issues and also the intensity of the competition among the OEMs in the car and the truck segments. That part needs to stabilize a little bit. And we believe that in another quarter or so, things will stabilize. Once they stabilize, we think we'll be able to start these engagements that we've been able to sort of seal over the last couple of quarters. So we do believe that H2 is going to be better than H1, especially towards the end of H2, we'll see growth coming back. So what I can say about, and it's going to be our effort to hold on to the margins while we go through this kind of transition.
All right. So 21% margins or so is, is something that you can maintain is the takeaway that we're getting. But, if I look at the growth, as you're saying, second half will be good. But should we brace for a degrowth in quarter two as well?
It's we don't talk about quarter-on-quarter numbers. All I can say, given the uncertainty continues, while we continue to start new engagements, there are pressures on the other hand as well. So, given the uncertainty, it's hard to say at this point in time. However, given the actual closures and the pipeline, we feel much better about the H2 of this financial year.
Okay, so when you say much better, can you give some more color on that, Sachin, in terms of what clients are saying, your deal pipeline, size of deals, nature of deals, and the pricing of those deals as well, given that we are in this AI environment?
Absolutely. And, to us, what we've been bracing for last couple of years is moving from being largely a services company to a solutions company. That's something that we started to do a couple of years ago. And now it's getting accelerated. What we have also done is we have created models that are AI infused for mobility, and we are applying those. And with those models, what happens is we take a broader view of a program and sort of cannibalize some of the stuff from our competitors and at times our own business. So that's the kind of transition that we are going through at this point in time. And we believe that this will continue. The name of the game is going to be solutions and products going forward. So we're reimagining our business in some sense. Hence, it's just going to take another couple of quarters for us to make that adjustment. In terms of the wins and the deal pipeline across the three geographies, I think we have had healthy closures from passenger car, trucks, as well as off-highway. Obviously, given our depth and breadth in passenger cars, the volume is much bigger there. But we are seeing some initial shoots, green shoots in trucks and trucks and off-highway as well. One thing I do want to say is there are three countries where we started to make investment. Sweden, where we opened an office recently, and there are a couple of large truck OEMs and one passenger car company. And we have started to focus on India for India and China for China. So we do hope that both India and China also contribute to our growth as we get towards the second half of this year.
We would have had a longer conversation, and we do hope we get the opportunity to speak with you mid-quarter once again. Just a busy day because of tariffs, you would understand, sir. Thank you very much for joining us with your perspective on the business and the lay of the land. HUL numbers are there at the bottom of the screen. 2730 odd crores is what the net profit looks like. 2535 crores was the poll. 15,930 odd crores is the revenue. 15,945. So these look like absolutely in line with expectation numbers. The EBITDA also almost, there's a 30-40 odd crore difference between the reported EBITDA as compared to the poll. Mangalam should join us in a bit, but I think let's just bring in Naveen Kulkarni for a quick reaction to these numbers. Naveen, if you've seen the basic set, your thoughts?
Yeah, overall, I would say that these numbers look okay to me. There is some bit of contraction in EBITDA margins is what I see, but I think that was expected. Revenue numbers, I think there's a 5% growth for the quarter, which I think looks quite okay. Broadly speaking, I would say that first reaction is kind of inline numbers, but a little bit encouraging that we can see some bit of improvement on sequential basis.
Naveen, what is the volume growth estimate that you have? If the first quarter started off like this, we were just speaking to Neelkant Mishra of Axis, and he, like many others in the market, believes the second half growth could start picking up. For HUL, what is your volume estimate and call on the stock?
So volume growth estimates was not much, right? It was very low single digits, right? 1 to 2% kind of volume growth.
For the full year?
No, not for the full year, for the quarter. Full year, I think we should end up, again, it will be low single digits. I don't think so we are going to have a significant number. Second half, it might pick up. So first half, second half, I think it might be in the range of around 4% to 5%. But again, we'll have to see how that picks up.
So then 4 to 5% volume growth and looking at valuations right now, what's your rating on the stock?
So we don't have a rating as such, but I would say that overall valuations are still not cheap. But of course, it has come off from what it was probably a few years back. If growth numbers pick up, I would say that the valuations will be justified and stock could do well.
Okay. All right, Naveen. Thank you for that. We've got Mangalam weighing in as well. Mangalam, we're desperately looking for good news. I don't know. Tell us what you think of HUL.
Well, these are largely in-line set of numbers as the street was expecting, nearly 3 to 4% sort of revenue growth. The company's gone ahead and reported that as well. There hasn't been a big dent in the EBITDA. In fact, the margins have been largely in line with street expectations of 22 to 23% as well. So 22.3% is what the company's written. The only couple of things that we are awaiting right now are the management commentary and the volume growth. The street was working with this time around a volume growth of anywhere between 3 to 4%, largely in line again with what the company's revenue growth has to be, because they've said that there would be low single-digit sort of price growth that may come by. So that was what the expectations were. And more than anything else, what the way ahead looks like in terms of demand would be extremely crucial to track for HUL, largely because, one, these results are in line. The underlying demand environment is improving. And for HUL itself, come tomorrow, we have a new leader joining in. Priya Nair joins in as Rohit Java steps down today after the board meeting takes place. So we will, await any sort of new strategy coming in from the new leadership out there. But these numbers absolutely in line. The stock obviously has seen a recovery from lows ever since the leadership announcement change was announced.
Okay, yes, absolutely. 3 cheers for Priya and Lady Power at HUL. First time ever in the company's history here in India. Mangalam, thanks very much for that. We've got Prakash Diwan joining in for a quick reaction. Prakash, look at the market environment. Look at lever. Stock's not done much. There's some anticipation of a turnaround. Is it a buy or is it an avoid for you?
So a couple of things that make it positive. One is the numbers could have been much worse than what they've come out with. This is very much in line, even if volume growth is as anticipated, low single digits. It paves the way, given the input side being so benign and a new leadership, there's continuity, there's a little bit of new energy. And remember, we'll of course wait for the internals, what's contributed to these numbers. But if personal care, hygiene, beauty products, those are the ones that start growing, they usually result into better margin profile as well, while it may not lead to great volume thrust. But so I think it stands at a cusp where things could only look up. It's a great handover for the new leadership. to take it forward. So quite positive. But I don't think the market's going to be disappointed or wanting to sell beyond where it is. Of course, it's still $600 short of the 52-week high, but that doesn't seem very difficult to cross as we progress in the next 9 months of this year.
No, absolutely. By the way, Prakash, the market reaction today, just if you didn't know that this 25% happened, 150 down on the Nifty, could be any other day.
That's what Surabhi said when you started off the market with the heat map. 0.5%, 0.6% is par for the course, Prashant. You're absolutely right. And remember, we are such a domestic-focused economy now. And growing on all counts, it might not make such a big difference given the volume of exports and just a few sectors being exposed. As long as IT and Pharma continue to be out of this, I don't think there's much to worry. It was sentimental. It was the tone of the messaging that was a bit harsh, which made people get a bit anxious. But I don't think the contents are really worth worrying about. So markets will go back to focusing on earnings, which is the right thing to do. And from that perspective, if the last 48 hours have been any indication with L&T and some of these other large numbers coming through M&M, I think we are seeing an earnings season that's shaping out to be much better than what we would have thought at the beginning.
All right, Prakash, thank you very much for that. What we'll do is we'll take a quick commercial break here. Markets are down 150 odd points. We'll come back with the top management at Mahindra & Mahindra to talk about their first quarter numbers, which came out yesterday. Stay tuned.
Stage.
Okay, welcome back. The market's down 160 odd points. So this is, pretty much like, have to say like any other day, 0.6, 0.7 odd percent lower, par for the course. Market breadth, though, is a little negative. 1,800, 1,900 stocks are down, and you've got about 600 odd names which are in the green. So about 3:1 is where declines to advances stands right now. As promised, we have Mahindra & Mahindra's top boss with us. They reported, of course, M&M reported numbers yesterday. Healthy volumes, revenue growth, but margins were impacted by, maybe a little higher proportion of EV sales. Anish Shah is Group Chief Executive Officer and Managing Director at the Mahindra Group. Anish, great to have you with us here. It's always a pleasure.
Likewise.
You in the studios. We'll get to the numbers in just a bit, but I have to address what is top of mind this morning, which is tariffs. Now, auto OEMs, in terms of exports to the US, is very small. So in terms of the direct impact, it's not very much. I'm not asking for a Mahindra company impact. But as a leader of the industry, Anish, auto ancillaries there are large exports into the US markets. How disruptive is this, and how do you think about it? Because when we started all of this in March and April, at a broader level, the expectation was that we probably will end up with a lower tariff compared to peers, countries around the region, etc. We're actually on the other side now. Most are at 15, 20, we're at 25 plus. Your thoughts?
The story is not over as yet. I think there's a lot to be done. And based on what we've seen our government be very balanced. There's a good relationship between both countries. So I think everything will work out well.
You think these will be negotiated lower? Or?
I think we're still a little ways away from the end state. So I'm very positive that things will work out well.
Specifically with regards to auto ancillary companies, I mean, any thoughts at all at a broad level?
I think it's still too early to say. I think we just have to wait to see how this progresses. We have to do what's right for the country overall, and I think that is what the government is doing. So I do feel that things will work out well. As I look at the UK FTA, I think that has been brilliantly done.
Yes.
It's a great win-win, and it's one that positions us very well on the world stage. And there are others that are in the pipeline as well.
So that's on tariffs, and fingers crossed, keeping the faith, like you're saying, picture abhi baki hai. Maybe that's how it's going to be, and 25% will not be the ultimate levy that we'll get. Now let's talk about the performance. And Mr. Shah, it's been superlative once again. Good volumes. The profit growth is, 30% plus. The revenue growth is 26%. But I want to come to the more challenging part, right? Because that's what the market always looks at, because your stock has done so well, and that's margins. Now, people will want to understand that as, the share of EVs keeps rising in your mix, and those cars are selling so well, right? What is the trajectory for margins for your automotive business?
So any new launch has lower margins, and that's what we've seen over time. And no difference here from an EV standpoint. With EV, it gets a little accentuated because we have 6 launches with one platform coming in with EV. And we have been showing the difference in margins for ICE and EV right now. Our ICE margins continue to be very healthy and very strong. And on the EV side, as volume grows, we will see that catching up. Volumes will grow over the next couple of years, and we feel that margins will be at par with ICE. And that's something that we have to demonstrate, as we have with all of our previous launches.
So just to put some numbers to that, ICE as things stand, as commodity costs stand, and competitive intensity stands, where do you see ICE margins by the end of the year? And where will the EV margins be? Or if not EV specifically, where would then blended margins be for autos?
So we've stayed away from any forecasts on margins. Our ICE margins were much lower 2 or 3 years ago. I know there was a lot of questions when the XUV700 was launched, because the margins were lower when that was launched as well. And at that point, we had deviated and given a forecast saying we will grow 300 basis points in the next 18 months or so. And we beat that handily and have grown much more since then. So we are in a very good position. My sense is we are probably the market leaders or close to it in terms of margins. And we will continue to focus on growth in margins, but more important for us is overall growth. And that is what you've seen us deliver. Our capacity has gone up 4x now in the last few years. And we continue to add capacity. And we continue to see very strong performance across each of our brands. In a flat or close to flat market, we've grown 22% this quarter. and market share is up 5.7 percentage points. That's something that typically is well beyond what we've seen anywhere.
But can we say that near about 14%, which is where your EBITDA margins are at the start of the year, first quarter, is that a floor, or could the flux and the changes in the mix, could it take it lower before it recovers?
In the world we live in today, I can never say something is a floor because we will always have some challenges. Okay. What we have learned is we get back from the challenges quickly enough and we come back. So I would look at it as a good margin for us. We will strive to continue to increasing it. We would love for that to be a floor, but the world we live in today, that may not always be a luxury.
All right, and beautiful to see those Mahindra vehicles on the road look absolutely splendid. That said, let's focus on the other part of your business, the tractors business. It went through a bit of a lull, I think 18 months or so ago, but the tractor industry itself is looking up and you have been gaining market share. What kind of a growth number could you give us in the tractors vertical? And your market share has already improved. Do you see further scope for improvement from here?
So industry has grown. Our volume is up 10% this quarter. You're right, our market share has grown very well. We are at 45.2%. On tractors, I would look at it slightly differently. At a 45% market share, our message to our teams is we are not going to focus on market share growth. We're going to focus on execution. That has been our message for the last 5 years. And we've gone from 40 to 45%, driven by strong operating excellence in what we do. And that is the approach to market share growth there. It is product, it's operational excellence, and that has worked very well for us.
Okay, all right. Mr. Shah, final question before we let you go. And I need to ask you this because we get asked this query quite often. Is there any kind of value unlocking exercise in the works? Would you consider demerging both these two businesses since both of them are flourishing now, both of them are growing at a good pace? Is that on the cards sometime in FY26 or FY27?
So this has been a question I've been asked for the last 5 years. And 5 years ago, I said, we're going to first focus on operating very well.
Yes.
And that will be the value unlock. We've grown a market cap 12x from April 2nd, 2020. And that has been hopefully a good value unlock. We still feel we have the ability to continue on that path of operating well, being able to grow, and all of this has been organic so far.
Right.
It has not even been driven by acquisitions. We will likely look at acquisitions, but we will look at it where we can significantly grow one of our current businesses, or we find some amazing opportunity that we feel we can deliver returns with. Because what I also want to highlight is a performance you see now, and you've seen that consistently for multiple quarters, is driven by all our businesses. Yeah. And we talk a lot about auto because it is a very exciting business.
Yes.
But Mahindra Finance, TechM, Life Spaces, logistics coming back very strongly now, holidays, Sustain, Excello, all of these businesses are contributing very well to our growth number. And that is what's delivering the value unlock.
So no demerger.
No demerger. We are hearing no demerger.
No demerger.
Is nothing for now.
For now. You said you've been asked this question.
Nothing for now. Yes, we will always look at value creation for shareholders. So it is never off the table. But as I said 5 years ago, we're going to first focus on what value we see today.
Yes.
And then we will evaluate what.
So in the near term, it's not on the table, but maybe we'll have to see how things unfold.
You spoke about, I asked you this question 2 or 3 quarters back, and you said, you turned the question on its head. You said there's a conglomerate premium, perhaps, not a discount.
We are starting to see it head that way, right? Because we are starting to see analysts recognize the fact that businesses being together can actually add more value. And that is what also, you're right, I've said this before, which is we will evaluate very carefully what is the value of keeping them together versus separate. Right? Our focus is on shareholder value creation. But we do believe that there's greater value in many ways of keeping them together. And that's what we've seen. So that's part of the exercise we will do at some point in future, not in the near future, possibly not in the medium term as well, but at some point.
And we'll keep asking you every quarter, maybe. We'll be nearer, but we'll see.
When my response is mistaken, at least.
So just a broader question. We've been, again, this is not new, but has consumption maxed out? That's been a question, even at the premium end. I mean, we've asked that question, but as your sales, SUV sales have shown over the last many years, clearly that has not been the case. But I'm asking again, are you starting to see a little bit of that, maybe?
In fact, very much the contrary in our view, because if you look at almost any metric, penetration of products in India is far lower than anywhere in the world. And India is growing as an economy. Yes, we will see some bumps along the way, as that will always happen. But rurals come back very well. Urban is slower right now. And I would expect the second half of the year for India to be a very strong second half.
For your business as well?
For the economy overall.
And but for your business as well?
For our business, I always expect the next quarter to be very good.
Just need to be at one of those Mahindra showrooms, and I was at one a couple of months back to realize there's no slowdown in India. But very quickly, you mentioned acquisitions. So is there anything cooking in the kitchen right now? Which segments, what size, geographies?
We are always cooking in the kitchen. And we look at anything that might help our current businesses position themselves much better. SML was a specific example on that front. But we have a very high bar. And we will do things only if they are accretive, if they make sense, if they will really add value for us as a group.
All right, Manish, thank you so much once again for dropping by. And it's always a pleasure chatting with you face to face. Really
Likewise.
Appreciate it. Good luck.
Thank you.
Thank you.
Well, I think that is the sort of view coming from the top as far as the Mahindra Group is concerned. 360-degree view. I mean, we started with tariffs really at the top, and then, of course, micro with regards to the business itself, and rounded it off with that, value unlocking a question as well. We'll take a quick commercial break here. We're going to come back more on markets on the other side. Stay tuned.
Welcome back. The equity market is still dealing with a cut of about 0.75%. Let's shift focus to commodities, see what's brewing there. Manisha is joining in with the latest. Good morning, Manisha.
Well, every segment and sector and commodity is brewing, but I have to choose one. So I'm talking about the crude oil prices right now. And we are trading at around 6-week highs onto this one. If you look at the month of July, this has been the biggest monthly gain since September 2023 that crude is posting out. And that is by, again, up of around nearly 10% for the month of July there. Well, the US has announced tax on Indian exports, and that's something the markets are looking at. There also is penalty for Russia oil imports. There also has been conversation about China here. So the concerns really come in right now is that India and China, because they are the exporters of refined crude, is what you could be looking at in shortage in the international markets there. Also, Russia is the top oil suppliers to India, with the kind of reports that are available right now do suggest that in first half of 2025, 35% of the overall oil supplies to India came in from Russia. So that's a significant number there, and that's exactly what the markets are reacting to as well. So as I said, there are concerns about refined product exports from like diesel from India and from China as well, and that immediate tight supply is what is keeping the markets in good favor there. Also talk about the US introducing very extensive sanctions on Iran. The highest and the most intensive, as I said, in last 7 years is what we're dealing with right now. And of the 20 companies who have been put in these sanctions, 6 of them really are in the Indian markets there. Companies that have been targeted also are in Turkey, in China, Indonesia, and UAE as well. So US has imposed sanctions on trading in many of these companies which are into petroleum and petrochemicals as well. All assets of these companies in US are to be frozen, and if there are US entities a part of these companies, that also will go into a freeze there. So, well, the US entities are prohibited to conduct businesses with any of these companies also. And interestingly, many of these Indian companies, and that should come on your screens really, have imported commodities like methanol, toluene, and polyethylene from Iran. Most of these companies also are into supplying and trading. Not too many of them are listed as well. And when you look at those names and those numbers and the kind of period and the imports that we've seen from Iran, clearly have been on the higher side. But as I said, it's not directly crude. It is to do with crude products there. And we are looking at 84 million or 51, 49. And these really are the company names that have been put out by US as well. If you look at many of these companies, the numbers are for 2024. And many of these are from October to Jan 2025 as well. And it has been millions of dollars, but the markets do believe that at this point in time, there's not going to be a very large impact because the quantum overall is on the lower side there. Apart from that, we haven't heard from these companies yet. And there is an addition in that statement that came in from US suggesting that these companies have the ability to appeal to be taken off those sanction lists. They will, of course, have to give various documentations and future accountability as well. So at this point in time, not too much of an impact, but we have those numbers coming in on your screens there. What the markets also will watch out for is the OPEC Plus meeting on this weekend. As of now, the conversation is that while OPEC has been increasing production from the month of May until September, October actually could be a bit of a pause there. The strength in dollar index is what seems to be weighing onto the markets right now. But even with that, $73 per barrel is holding for the Brent prices, with markets believing that even as July is ending 10% on the higher side, August could be equally bullish.
Okay, all right, got it. Thanks very much for that. Manisha there with the commodity cues. By the way, just let's fire up the HUL intraday chart if we can. That commentary has really sparked off lots of buying. They're saying sequentially margins can improve. And if commodity prices remain benign, then they're talking about some price growth as well. And the market loves the sound of that. It's almost 3.5% up on HUL. Well, with that, we'll take a quick break. On the other side, Lata, comes in and she discusses the impact of this 25% tariff on India. If these tariffs stick, then how big a hit will it be for the Indian economy? She'll be in conversation with Ajay Srivastava of Global Trade Research Initiative and Abhishek Upadhyay, Senior Economist at ICICI Securities. PD.
No surprises on It's the Economy. We are going to talk tariffs. I just did a dipstick survey with economists before I came into the show, and the impact of the 25% tariffs is seen as between 0.3 and 0.6% of GDP. But this doesn't include the penalty, since we don't know what the penalty is or whether 25% itself is the penalty. The problem in calculating impact is that part of the tariff usually gets passed on to consumers, part of it is borne by the exporter, and part of the hit is absorbed by the depreciation of the rupee. Look at the depreciation of the rupee over the past few days. Keeping these points in mind, let me invite our two experts to decode the impact of tariffs on both the macroeconomy and micro sectors. I have with me Ajay Srivastava, the founder of Global Trade Research Initiative, a Commerce Ministry executive himself in his previous avatar, and Abhishek Upadhyay, senior economist at ICICI Securities PD. Gentlemen, thank you very much indeed for your time. Abhishek, first the macro point. This is what I got, 0.3 to 0.6. Can you explain how we should think about the macro impact, given that we only know part of the hit, 25%?
The issue with estimating the macro impact, as you know, is we don't know how long these tariff rates are going to last, what will be the penalty. And as you mentioned, what part of it will be absorbed by the Indian exporter, the US importer, the US consumer. And then on top of, those assumptions, typically you apply, how elastic Indian exports will be once you have some color on how, high the US consumer prices are going to be. But making some heroic assumptions here, assuming at least the penalty part of these tariffs, where we have no clarity, and assuming that is temporary, and the effective rise in tariffs is, for India, somewhere between 20-25%, and roughly 1/3 of that is absorbed by the US consumer in terms of higher prices. We assume maybe 30-40 basis points impact on growth from there. The reason we are not calling for a bigger impact, even this impact we have to see. This impact we'll only see if these tariffs stick for few quarters rather than few months. The reason we're not thinking bigger impact at this stage is two reasons. One, we have seen rupee already has underperformed other currencies. So while dollar has weakened more broadly, rupee has not appreciated in the same light. And on real basis, rupee has depreciated. Second, some of the competitors for India also are absorbing relatively higher tariffs. So the best case scenario, it appears, would have been 15% tariffs. We are stuck with 25% tariffs, excluding the penalty impact. And third, there's already been some front loading of exports to US. So if you see first 3 months of the fiscal year, April, June, exports to US have grown roughly 22% YOY. This compares with overall growth in goods exports of just about 2%. So already a lot of these exporters have front-run faring higher tariffs, and that provides some cushion, some time for us to see if negotiations work and tariffs come down. Therefore, we think, growth for this year, which we were thinking earlier, 6.3%, could still be closer to 6% rather than lower.
Mm-hmm. Yeah, actually, the last midnight soundbite that came out, I think it was a tweet, that came from President Trump looks particularly from a person who's irritated with not getting a deal. It didn't look very positive, so I don't know if there is a plus penalty or whether 25% is the penalty. Mr. Srivastava, what would be your initial reaction? Is it going to be a big hit? Or, as Abhishek says, rupee depreciation and passing on some prices will make it easy to suffer this?
So I take it as very normal process in the US. They were to announce new tariffs from August 1 on the countries with which they could not get the deal. So if not yesterday, the tariffs would have been announced on India, say tomorrow. So 26% was already expected. Penalty was, of course, the surprise element, and we have to yet to know what's the quantum and why. Is it because of Russian oil or BRICS membership or something else? So penalty amount will decide. And I personally see this as a pause in the negotiations. Negotiations have been continuing, and we heard that US team will be visiting India in the second week of August. And this is just a pause Trump, being Trump, he uses offensive languages and loses friends in the process. But I think they need deal with India desperately. And my guess, I could be totally wrong, but I still stick my neck out, is that, India is willing to give them access to 95% of their exports to India. That is industrial goods. Agriculture accounts for less than 5%. Now, India, most of the agriculture is red line for India. Trump understands this dilemma of India, that India cannot allow most of the agriculture. But suppose he does a deal with India today, then all other countries will be approaching Trump, please leave our agriculture. Right now, he could get Japan or European Union to sacrifice their agriculture. But suppose he does a deal with India today, then no other country will be committing to agriculture. Okay. Maybe that will be the reason for delaying this deal.
Fair enough. Yeah, fair enough. Maybe, therefore, he'll arrive at a deal with us last and after he has struck the agreements with others. But, Abhishek, you were calculating because of the hit taken by the Indian exporter and partially passed on to consumer, the hit will be probably about 0.3, 0.4, which is what most people are reasoning. Do we stand to gain because we don't have to buy expensive oil? We are free of other conditions. Would that be adding on a little bit, and therefore the hit to the macro may not be very much?
Well, concessions which other countries appear to be giving, the major ones include, investments in US, defense purchases, energy purchases, etc. It was likely that India would have had to make some of those concessions. I don't think there's a big negative impact if India, instead of buying oil from a different source, purchases some of this from US. Maybe the cost is higher, but I don't think that is a big drag. I think what we need to see here is, now that US has started to impose secondary sanctions, a penalty is a sort of a secondary sanction for purchases from Russia. What impact this has on variables such as crude prices also. If crude prices increase, I would think that is, a separate hit that, we may get, on growth from there. So there are a number of moving parts here. At this stage, difficult to really consider the impact of those other moving parts.
Okay. What's your sense, Mr. Srivastava? Do we save precious dollars because we went to Russia because it is cheaper? Other than the strategic diversification of sources, do we save some money and not being forced to buy military equipment, which may not necessarily be our first choice or our best choice? Does that save us something?
So 2-3 things are there. Military equipment doesn't mean that suppose we buy planes, that's sufficient. No, we have to buy all the supporting structure. And we have committed a large amount of money for, say, Russian ground structure. Replacing ground structure of Russia with another country, I don't think we have any sufficient reason given by Mr. Trump, especially when America always stands with our enemies during our weak time, all the time. So I don't see. On oil front, Trump got Europe to commit that Europe will be stopping buying all the oil energy from Russia and buying everything from US. But if you see the US production, it's not sufficient to supply to European demand. Forget about the rest of the world. And he's getting other countries to get commitments to buy oil, every one of them, without even knowing what their capacity is. I think we need deeper understanding of these issues.
Yeah, I believe Morgan Stanley tried to make that calculation that if everyone actually acceded to US demand to buy crude from them, they will take up until 2027 to be able to supply all that crude. That's the rate at which their own crude production is increasing. So yes, there is a catch over there, but at the moment,